Good morning. Welcome to Market Monday. Last week we rang the bell on the Bloomberg 100% recession call, being utterly wrong. But this wasn't the first time a media outlet has declared some market prediction that didn't pan out. Here's Bloomberg again, this time from August 12th, 1979 issue of Business Week. Just a short couple years before the start of arguably the greatest bull run in equities the world has ever known.
It wasn't the first, and it certainly won't be the last. Stay vigilant out there. Also last week, Disney turned 100. But it was back in 1966 when Warren Buffett, at the age of 36, invested $4 million to acquire 5%, yes, 5% of the whole company for $4 million. Buffett ended up selling his stake just a year later for a very nice 50% gain. But had he held on, that $4 million would have turned into $8 billion with a B. Quote, a huge mistake, says Buffett. Folks, at the end of the day, we're all human, trying our best to set us up for long-term growth, to make reasonable bets, to let the winners run. But as investing inherently deals with an unknown future, flawless investing can only be achieved with the benefit of hindsight.
Indeed. But what if you don't want to or simply can't pick the next Disney or Apple or Amazon? Do you still have a chance of substantial long-term gains? You bet. But the path isn't a straight line. You had to endure brutal, existential drawdowns. And only if you had the fortitude to do nothing, yes, do nothing is actually something in our book, you could have turned $100,000 into $1.7 million. Just time, faith, and doing lots of nothing.
See, these are just squiggly lines to us now, but then, in the moment, it felt like life and death. And for some, they did lose everything. Here's the US recession, 9/11. .com bubble. Then we finally recover, only to be hit with a near end to the financial system as we know it. Let's not forget the US credit downgrade and European debt crisis. Remember that? Barely? Exactly. Just a faint, distant memory, if we remember it at all. Then, of course, COVID, and last year, which was made much worse by a cratering bond market, longest bear market in modern history.
Yet today, and tomorrow, and the next week, and the next month, and next year, will all be jagged lines that we look back on and reminisce on how tough these times were. But despite it all, you could have turned 100,000 into 1.7 million by absorbing the volatility like a lead vest.
But it's not just the volatility, it's the noise. It's noisy out there, isn't it? The Fed used to put out a one-page written statement after its meetings. Now, look at this. We have all these different Fed speakers. Some vote on rate increases, that's the V. Some don't, the NV. But that doesn't stop them from speaking.
This is just 2 weeks. 14 speeches in 2 weeks, an average of 1 per day. Really? The Fed is at or near peak? No, wait. May need to raise again. Which is it? Just like economic data drops, folks, this is media catnip. Tune it out.
Yeah, but that was just a busy speaking schedule. It's not always like that. Not so fast. Here's the following week. 3 and 4 and 5 Fed speeches per day. This is just one work week, folks. Think the media won't squeeze confusing and conflicting headlines out of this? Tune it out.
Whether the Fed hikes again is out of our control. No. What is in our control is our allocations after the Fed's last hike. So far, the Fed's last hike was in July of this year. There's about a 90% probability of a pause at the November 1st meeting in a couple weeks. Beyond that, who knows? What we do know is that historically, on average, both stock and bond markets did well during the 6 months after the last hike. Of the 8 hiking cycles over the past 40 years, both value and growth equity was up double digits. Bonds were also up 6 to 8%. Every cycle is a little different, and there's no guarantee this one will work out like the others. But it's important context to cut through all of the noise out there.
A lot going on out there. Coming up on 22 months into an equity drawdown, almost 2 years of quote unquote being down, over 3 years in a bond drawdown. It can be frustrating, especially seeing costs and expenses go up. It won't always be like this. We will see new highs again, just a matter of time. We have to hang in there, barrel into this, and remember that one day, today will be a blip on the screen where we look back and say, that was a tough one, but we grinded it out to see better days ahead. Have a great week.